Should you invest your money? And if you should, why should you do so? Hello and welcome friends to this video on the why of investing. Before I jump right into the video, I would like to tell you a bit about why this video series and what's going to follow in the near future. This is a short video series which is going to focus mostly on the fundamentals of investment and financial management. So if you're someone who is interested in learning more about the personal finance, investment options, do subscribe this channel so that you don't miss any updates, any videos coming in future. And I would like you to share this with others as well so that they also can learn. You can also visit my blog website, and the link for the same I am posting in the description below. You can go and check that blog out. That blog is not limited only to the financial management. There are other things covered in that, so it's a quality content on technology, finance, and a lot of other stuff as well. I would urge you to go and check that blog for yourself. Now let's start our video. So why should we invest? I think this is a very important aspect of personal finance, and understanding a proper rationale behind it is also a very important point. Now, have a look at this graph here. We can see clearly that the numbers are the inflation numbers between the years 1960 to 2019. And if we look closely, we can derive this very simple conclusion that overall the inflation rate has fluctuated a lot, but today the rate still stands on a higher point. What this means? Inflation directly affects the cost of goods and services which are available for the consumers in the market. And with increased inflation, goods and services tend to become more expensive and the value of money goes down. So this is very important, friends. Value of money goes down. This is what inflation does to our money. When the value of money goes down, that means whatever wealth we have created, the overall wealth in terms of the monetary value, that also goes down if we are not following a proper investment strategy. When the value of money goes down, it also starts reflecting in our financial goals, financial commitments also. If we have created a good mix of investment tools to meet our financial goals, I think then we should not worry more, but still we have to check that how inflation is affecting us, how inflation is affecting our overall savings, our overall investment plans. Let's see the small example here to understand more about the relation between the inflation and the eroded value of money. So this example says that 100 rupee in the year 2000 will have the same value which rupee 350 holds in the year 2020. So you can clearly see that how 250% inflation has already eroded the value of money. So that's why, friends, if you're not doing proper investment planning, that means we are somehow we are affecting ourselves. We are affecting our financial goals. So now, since we have understood that investments are going to help us better in the long run, as they can help us with growth and value addition to our savings, let's take a step back and try to understand what's required before we actually start thinking about investments and investment planning. The very first step is to look into a savings discipline. What that means now. A good savings discipline can help us create a great corpus for our investments. So, we should first really care about creating a savings discipline. Now, the next question is, how should we go about it? What's the right approach? As per various general rules available with us today, because a lot of gurus, a lot of financial gurus, advisors, they tend to say us that savings is very important, you should do it. And you should make it mandatory for yourself to set apart some part of your income as savings. So let's discuss some of the rules here. So a general rule says the savings should roughly be between 10 to 20% of our income, and that's the part which should be disciplined, which we should be disciplined enough to pay ourselves first. Because if we do not pay ourselves first, we would somehow manage to spend that money. This is the same principle which is mentioned in that book, if you have read it, Rich Dad Poor Dad. So in that book also he says that whenever you get your income, you should pay yourself first. And trust me guys, this is very important, because without it we cannot be thinking even about the next step. So ideally, if you ask me about a split, I would say divide your income into three parts. Savings should be up to 20%, essential expenses should be up to 50%, and desires should be up to 30%. So now if you would like to make some changes in here and choose for you what suits you better, you can do that. But keep in mind that minimum savings should be 10%. Once we have done that, and once we have achieved that savings discipline being created for us, first of all, let's give us a pat on the back, because we have achieved something. We have laid out the groundwork for the next step, which is writing our financial goals. So once we have created a savings discipline, the very next step is to start writing our financial goals. Writing of financial goals is important, and why it's important, because it will help us decide on the type of investment mix we are going to choose for us. So I would recommend here splitting our goals into two categories. One is the short-term goals and other one is the long-term goals. Let's take an example here and list some of the goals for your convenience. So buying a house. So I think for some it could be a short-term goal, for some it could be a long-term goal as well. Child's higher education should be a part of long-term goal. Child's marriage, again a long-term goal. Retirement corpus planning, a long-term goal. So I'm writing here long-term because I'm thinking from my perspective. So yours could be different. So you can list your goals accordingly as per your scenario and situation. And this is just a small example list. So this list could be more comprehensive for you because you can have multiple goals in this sheet. But make sure that you make this goal sheet today, so that you can start thinking about your investment journey today. And choosing these goals very carefully is very important, because this is going to make your investment planning journey more smooth. Now, once we have done this also, let's move on and see how now we can start our investment planning journey. For this journey, we would need the right tools, and in today's world, we already have many tools available for us. So what's important is you should choose these very carefully according to your needs. So let's see what kind of tools we have and who should choose what. So we have a lot of conservative investor tools, for example, the provident fund schemes, deposits, gold investments, and real estate. So all these tools are good for those investors who doesn't want to take any risk, who just don't want to risk their money. They just want to go safe about their investments. So they should go blindly with these kind of investments. But for those who want to create a good mix and who want also to be in the aggressive investors list, they can probably choose stock markets, mutual funds, and all the indirect investments in the stock markets. Those also could be included in the portfolio. So now when you talk about stock market, so don't worry much about this, because it's not something which I'm saying here that you should choose and directly go into the stock market and start buying the shares for you. No. So there is an indirect route for investments in the share market as well, which you can choose today. So today we have a lot of other options through which we can directly invest in the market, because market's health represents the economy of a country. Investing in markets means we are investing in the economy. An economy, if it's growing, if it's healthy, that means our financial conditions are also going to be better. So I think creating a good mix is important. So to conclude this, I would say you should have some conservative tools, some aggressive tools, A mix of these two should be there in your portfolio, in your investment planning portfolio, so that your goals could be met accordingly. Now, once we have done this, let's congratulate ourselves that we have come this far, and we have covered both that why should we invest, and in addition we also looked at the various tools which are available in the market today. So before I conclude this video, let's have a look at a small example. This is just for fun purpose, I put it here. I have taken 3 different routes of investment for an amount of rupee 1 lakh, and if you look at these 3 different routes, 2 are the conservative options and the third one is an aggressive option. The first 2 options, if you look at, they are giving us returns between less than 8% or somewhere in the range of 6 to 8%, whereas the third option, which is the stock market route, it is giving us returns of roughly 12%. And you can see the difference in the value which is created over the long run. I have taken a 5 years horizon. You can choose according to yourself, and there are a lot of calculators available. I'll post some of the links of these calculators where you can really go and see that how much should you invest to meet a particular goal. There are a lot of SIP planners available today. So I'll be discussing more about these tools and how to create a very good portfolio for you so that all your goals are met and you are running in line with the kind of investments you're planning to make. So I think there's a lot more to cover up, but it can't be covered in just one video because it would be too long. So I'll just take a pause here, friends, and if you like this video, I would request you to please like it, hit the like button and share it with your friends and family members so that they also can be a part of this journey. So till we meet again in the next video, stay healthy, stay safe, and thanks for watching.